Abenomics is the program of monetary stimulus and economic reform designed to get Japan back on a track to growth. It has boosted corporate earnings through a weaker yen and lifted stock prices. But is it really doing much for the underlying economy and for the megabanks in Japan? Joining me to discuss this is Chikako Horiuchi, Director in Financial Institutions at Fitch Ratings.
Good morning.
So loan growth is stalling and reserves at the central bank are rising quite dramatically. Does this mean that Abenomics is not working?
Abenomics had a positive impact on banks' performance during the first 3 quarters in this fiscal year because stock price was rising because of the investors' expectation for Japan's economic growth. And 3 Japanese megabanks announced the third quarter result, which was an improvement, strong improvement. But the driver was because of the stock market activities, and stock market activity is volatile in nature and also was also underpinned by the depreciation of the Japanese yen, which has been stabilizing recently. So Fitch thinks that the positive impact is temporary and also not sustainable so far.
And the fact that the money is being parked in the central bank rather than going out in the economy, does that say anything about the Abenomics program?
There are limited alternatives for investment for the excess liquidity for banks apart from Japanese government bond or the central bank's current account. And these investments are not very attractive from the bank's profitability perspective because they only earn thin margins. Therefore, that drives the banks to look for opportunities outside of the home market.
And where there is loan growth, is a lot of it still short-term M&A type bridge financing, or is there real corporate investment being funded as well by the banks?
Japanese banks' lending balance started an increase very moderately, but then the driver is short-term M&A financing, short-term nature. And if you look at the SME sectors or retail sectors, which accounted for a large proportion of the Japanese banks' loan book, it's still demand is muted.
And in terms of the net interest margins and what's happening with the money at the that's on reserve at the central bank, I mean, how long can banks carry on leaving that money just sat there?
Because, as I said, it's limiting the profitability improvement, they don't really want to leave it for longer term. Therefore, they are looking for opportunities outside of that. And that includes overseas expansion, which they have been active during the last couple of years. They've
been quite active, as you say, in buying stakes, especially in Southeast Asia, among other financial institutions. Have they been overpaying for these businesses?
We see that their overseas expansion has been quite cautious and it's more organic focus, partly because their development of the risk management capability, but then also their capital level has been constrained, the speed of their mergers and acquisition outside of Japan. And if you look at the trend of the major banks' capital level, they have been strengthened during the last few years. And because of excess liquidity and strengthened capital, they started refocusing on the more inorganic way of expansion outside of Japan now.
So will these deals really make a difference to these banks long term?
It is going to contribute to an improvement in the profitability, but also that is inevitably taking higher risk.
Thank you very much.
Thank you.